The last stock market crash was in 2008. This was over 10 years ago. The one before that was in 2000. That's 8 years before the last crash. If history is any indication, the market lasts about 9 years before a crash. This means every 9 years or so, the American market sees a drop of 20 to 60%. This also means that we might be overdue for one soon. Stock market crashes are usually caused by panic, companies being overpriced, or a sudden drop in the economy. No matter the reason, the end result is a year or two of a bear market, meaning your money keeps dropping, all the way to negative 60% in some cases. So let's look at the best way to protect ourselves so we're not bag holding when this happens. You really need to understand that time in the market is so unlikely to work that it's not worth doing. Meaning if you think you could sell all your stocks now and keeping cash into 2020 will work, it probably won't. There's technically a bigger chance of a drop the longer we're in the bull market, but there's no reason it won't drop 20% and go back up again. Meaning you cannot wait in all cash into a certain percent, like 40% or more of a dip. Look at the end of 2018 as an example. We were so close to a bear market until it bounced back up. Here's a chart of the S&P 500, representing the American market as a whole. It actually went down 20% in the red at the worst. Let's say you try to time this and decide to sell as soon as it went down 10%. Right now you're only 10% in the red. You decide to wait until it's 30% in the red before buying in. It was the lowest in December 24th, down 20% at this point, but you think no, it can drop all the way to 40%, so you don't buy in and keep waiting. It bounces back 10% from that point, but you think it's still a trap and will fall after. Now it's back to break even, and you don't know what happened, losing that initial 10%. There's no real way to time this unless you magically knew when to buy in. No one is psychic. So how do you invest safely at a time of uncertainty? The first way is using dollar cost averaging. Trust me when I say this. This is the easiest method to keep yourself safe, and I'm gonna do the math to prove it to you, using the last market crash and the S&P 500. Understand that doing this in the bull market means less returns, but also means less risk. As we know, in the stock market, less risk means less returns, and vice versa. Dollar cost averaging just means buying in stocks over a period of 1 year instead of all at once. The advantage is that you're not setting your cost basis at the top of the market. For example, if you have $100,000 and invested all of it in the S&P 500 in 2007, we might have bought at the highest price before it dropped. We would be down 55% and only break even by 2013, up 85% by 2019. Not the best returns for 11 years. That's a waste of 5 years, because we made a mistake of investing everything at once. What if we invest just 10% of our money every month for the next 10 months? Our average price would be somewhere in the middle here, at $120 instead of $150. We will be in the green by 2011, a whole 2 years earlier, and be up 127% in today's price. So if a bear market is coming next year, and we invest just a bit at a time, our cost to get in the markets is lower every month. We're lowering our cost basis by doing this. This works very well, but only if a bear market is coming. This way we can invest in the markets using a whole year instead of timing it for today. But to add to this strategy, we can also buy a lot more when the market drops, meaning at this 40 to 50% drop in 2008, we save 80% of our income and invest. This is because you always want to buy low, and a 50% drop is the lowest the market will likely go. We had a 127% return if you bought in at the highest points, but slowly. How much can you get if you invested more money during the 50% drop? If you bought in with $100,000, we would have $227,000 today, not counting dividends. But if you bought more, $50,000 during the heaviest dip, let's say you bought in over a year and got an average of 45% dip, or $89 as our average price for the $50,000. We will be up over 225% on that money, or $112,000 of profits. Adding $112,000 to our $127,000, we have a total of $239,000 profits. This is a 159% profit in the past 10 years. Even if you started buying at the worst time, right before the crash, this is not as great as straight up buying here at a 50% dip, but that's extremely unrealistic. Compared to the first guy who just bought at the highest points and got 89% in 11 years. We bought more in the dip and received 159% instead. That's a 70% difference because we were patient and buying more at the heavy dips. We will see how I'm doing this with my portfolio later in the video. The second way to protect yourself is investing in safer companies. Think of a few sectors that survive in recessions. The first thing that comes to mind might be cheap food. Let's look at what happened to McDonald's in 2008. Back when everything was dropping, McDonald's was actually going up. It had a small dip of 15% here, compared to 55% in the market. And then it kept going up. McDonald's is up over 200% since 2008, beating the S&P 500. And that's with a 2.3% dividend. This is because some stocks do survive the recession. People will be eating cheap food instead of expensive meals, if the market as a whole is down and money is running low. So it's a good idea to have a few safer stocks in your portfolio. This way you're not holding just cash for the coming years. In the best case scenario, your safe stocks didn't drop and you can sell them and buy some stocks on sale. If Amazon is down 50% and your McDonald's didn't move, it might be a good idea to sell McDonald's to buy some Amazon. You might see huge growth on the riskier companies. Let's look at two safer stocks that might survive a recession. Thinking more about a recession, people obviously can't afford expensive stuff, so stay away from the expensive cars, and probably vacation stocks as well. Some good stocks to watch are the ones with a long history of dividend payments. These companies tend to stay strong in a downturn. A stock with a 1.9% dividend is Waste Management. People will still make garbage during a recession. This is necessary even when everyone is poor. Looking at the charts, they dropped around 35% in the last crash, but soon recovered in less than 2 years. Much faster than the market as a whole, which took 5 years to recover. So if you own this stock, your money would have stayed at zero instead of losing half of it. Another good company in general is Walmart. Selling extremely cheap stuff is perfect for a recession. Imagine if half your money is gone. You will be shopping at Walmart. This is actually a stock I've held for a while. Definitely not a bad company, with a dividend of 2%, but a fairly high PE ratio right now. This stock actually went up 30% while everyone else is dropping. At the end of 2007, it had a nice spike here before dropping a bit. But this is one company that's entirely green throughout the last market crash. Definitely a good stock to watch for the safer part of your portfolio. Let's look at my actual plan with real money. I'm going to show you my actual stock portfolio and how much cash I'm holding. Here's my portfolio, a total of $345,000. I have $55,000 in cash sitting in my bank, so in total I have $400,000. As we can see, there's currently $223,000 in the market. This is a pretty good allocation already. I just reduced my index funds by $40,000 to $91,000 total, which is 23% of my net worth. In single stocks, I have $132,000. This is actually pretty risky, since I want a 50-50 balance of single stocks to index funds. Let's go to my actual portfolio to see what I own. Here are my two index funds, the S&P 500 and Nasdaq 100. $33,000 of the S&P 500 and $58,000 of Nasdaq 100, for a total of $91,000, 23% of my money. And in single stocks, a huge chunk is invested in marijuana companies. I have over $28,000 in Aurora Cannabis, up 51% so far, and over $18,000 in Canopy Growth, up 8% right now. So that's $47,000 in REIT stocks, about 12% of my money. For these companies, I wouldn't invest more than 15% of my money. For single stocks in America, we're not doing as well. Facebook is actually green, so this will be a nice payday soon. Other companies include Activision Blizzard, Best Buy, Constellation Brands, EA, FedEx, IQ, JD, Micron, Nvidia, and Tesla. These are down anywhere from 10% to 30%. But marijuana stocks and index funds are keeping my portfolio in the green. This is about $78,000 in single American companies, or 20% of my money. Right now we have 23% in index funds, 12% in marijuana stocks, 20% in American stocks, for a total of 55% invested. This also means 45% cash, or around $180,000. To reduce our money in the markets, it's a matter of saving more cash. I don't have to sell any stocks in the red, as long as I save more money from my business. YouTube made me $5,000 this month. I can add that money to my total, giving me $405,000. This will increase my cash percent while decreasing my stock percentage. I want to keep my stocks around 50%, possibly as low as 40%, as protection against a possible crash. I may also buy a few safer companies like Walmart in my tax-free account. This account is for extremely long-term investments, because it costs money to withdraw money from it, much like a Roth IRA. Now that we have an idea of my portfolio, about 50% cash, 50% stock soon, when will I actually buy more stocks? Let's make up a crash scenario coming in 6 months. I won't time the markets, but I will slowly invest in, putting more the deeper the crash goes. We start with $400,000, $200,000 in cash, $200,000 in stocks. In this scenario, where the market crashes coming in 6 months, I'm saving more and more cash. Right now I'm bringing in more than $15,000 a month that I can save. By month 6, this will add up to $100,000. Let's say by that point, I sold a few of my single stocks and also bought more safe stocks. I bought some McDonald's, Walmart, AT&T, and Waste Management. I still have $90,000 in index funds, $47,000 in REIT stocks, but of the $63,000, $33,000 are in safer stocks, while $30,000 are still in swing trade companies like Tesla. At a 6-month point, I made an extra $100,000 from my business. I saved $60,000 as cash and $40,000 in safe companies and index funds, giving us a total of $500,000 net worth, if the market hasn't moved at all. $260,000 in cash and $240,000 in mostly safe stocks. The market begins to drop. Let's say 5% every month. What would I do in this situation? Using what we learned earlier, we know to buy more when it goes down, and aggressively buy if it gets anywhere near 50% in the red. So slowly I will buy more stocks as they're dropping. I want 50% in index funds, so every 5% the index drops, I will keep adding money to it. I might buy a few single stocks that are dropping harder if their numbers are still good. For example, companies like Apple, Amazon, and Google will all be dropping. If they're down 20%, we buy a little bit at a time. After 6 months, I spend a chunk of my cash buying more stocks, $130,000 on my cash and another $100,000 for my business, leaving me $130,000 of my original cash. At this point, I see the index fund is down 50%, so I buy $70,000 worth, and I buy another $60,000 in good companies that will likely survive. Where will you end up in the markets if it goes back to normal in a year? If you assume our original money went back to zero after a 50% crash, then our original $200,000 stayed the same. We added $40,000 in stocks in the 6 months. That also stayed the same since the market didn't move. $240,000 is back to zero and didn't move in the past 2 years. After that 6 months, it began crashing at 5% a month. Remember, we didn't time this. We just kept adding half our money in. We bought $70,000 at a 50% dip in the index fund, and $60,000 at a heavy dip in single stocks. That's a profit of 100%, or $70,000 on the index funds, and a conservative estimate of 130% for the $60,000 on single stocks. Not every stock will bounce back perfectly, but buying a good company like Apple should give us higher than 100% returns if we bought it at a heavy dip of 50% or more. That's a profit of $78,000 on our $60,000. Then we have $230,000 we cost average in. Assuming our average is somewhere near the middle of the top price and a 50% dip, you might see a 30% return on those investments. 30% of $230,000 is $69,000. 69 plus 78 plus 70 is $217,000 in profits. We started with $400,000, made $200,000 from our business, for a total of $600,000 potential money to invest. This $217,000 is a return of 36% in those 2 years. This is a fantastic return to get in a market crash. Imagine if instead of this, we bought in $400,000 at the highest price. We didn't buy any more because of fear, and kept the extra money we made from our business as cash. 2 years later, we're break even and didn't make anything. The disadvantage of keeping half cash is if the market doesn't crash. This means we might lose possible gains. Imagine if the market kept going up for another 25% in 2019 and 2020. We only invest half our money. We would miss over $50,000 in returns. That's the risk we have to take. It's better to not gain as much now than to lose money or gain nothing during a crash. In this situation, you have to estimate the next crash. It's been 10 years.